Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial guts of publicly traded companies. And let me tell you, TrueBlue Inc. is serving up a financial buffet with a side of interesting. This report is for their second quarter ending June 29, 2025. And we're going to decode what these numbers really mean for this workforce solutions provider. Before we dive in, if you appreciate getting straightforward insights from dense corporate filings, do us a favor and hit that subscribe button. And if you want to join a community of like-minded investors and get ahead of the curve, our Discord server is linked in the description below. You should totally join us there. All right, let's look at TrueBlue Inc. This is essentially their business checkup for the first half ending June 29, 2025. Think of it like a doctor's report for the company's health and performance. First up, the balance sheet. This gives us a snapshot of what the company owns, what it owes, and the value belonging to shareholders. Right away, we see accounts receivable at $225.7 million. This is the money clients owe them. It's a decent chunk of change, and they have an allowance about $1 million set aside for customers who might not pay. That's pretty standard. Then we have property and equipment at $85.1 million. This is everything from their offices to their tech. It's gone down a bit from last year, which might mean they're becoming more efficient or maybe retiring some older assets. Now check this goodwill number, $42.6 million compared to just $24.5 million last year. Goodwill is basically what the company paid over the fair value of a business it acquired. This big jump suggests they made a significant acquisition and are betting big on its future success. Normally you'd want to see growth in operations to justify this, but we'll get to that. And a really interesting figure here, restricted cash equivalents and investments are $154 million. This is money the company can't freely spend because it's usually set aside for things like insurance claims or collateral. It's quite a large amount. Total liabilities stand at $367.6 million. They owe more than they owe in terms of short-term current liabilities, but overall they have more assets than liabilities. Shareholders' equity, the true book value of the company, is $305 million. It's slightly down from last year. Now let's talk about how they actually made or lost money, the income statement. Total revenue for the 13 weeks ended June 29, 2025 was $396.3 million. Get this, that's almost exactly the same as last year. This means despite the economic chatter, their top line stayed flat in the short term. But wait for the longer period, the 26 weeks ended same date revenue actually dropped 4.1% to $766.6 million. The company says an acquisition boosted these numbers, but without it, they would have seen a decline. Not a great sign for organic growth. Gross profit, which is revenue minus the direct cost to provide services, was $93.6 million for the 13 weeks. But here's a more important number. As a percentage of revenue, it's 23.6%. That's down almost 3 percentage point 4%. This means for every dollar they make, they're keeping less profit after covering the direct costs of their business. They attribute this mainly to a shift in their business mix towards lower margin services. Selling, general and administrative expenses, or SG&A, were $89.8 million for the 13 weeks. That's an improvement from last year, a good sign of cost control. They managed to cut this by about 7%. And then we see this goodwill and intangible asset impairment charge of just $2,000 this quarter. This is peanuts compared to last year when it was almost $60 million. Last year's big charge was likely due to a reassessment of acquired businesses and their values. A smaller charge this year suggests things are more stable, but that big jump in goodwill on the balance sheet still needs to be justified by performance. The bottom line is they reported a net loss of $16,000 for the 13 weeks. Again, a huge improvement from last year's massive loss of over $14 million. For the longer 26-week period, the net loss was $14.5 million, a significant improvement from $10.6 million lost last year. They're losing less money, which is good, but they're still losing money. Looking at the 26-week period, net cash used in operating activities was $33.9 million. They spent more cash running the business than they brought in from day-to-day operations. This is not ideal. Investing activities used even more cash, $19.8 million. A big chunk of this was for that acquisition we talked about earlier, the one that added a lot to their goodwill. But look at financing activities, they brought in $45.1 million. This was mainly from borrowing money or drawing on their credit line. This helped them cover the gap from operations and investing. It's a sign they're using debt to keep things afloat. Let's move on to the risk factors and what's new. They're upfront about the biggest risk they face. Their business is super sensitive to the economy. If businesses aren't hiring or expanding, TrueBlue Feels it directly, they mention factors like interest rates, recessions, inflation, and political changes all impacting client demand. This is a constant battle for them. They also talk about acquisitions. While they can be good for growth, they may not work out. Integrating new companies is hard and can hurt their operations if not done perfectly. This is especially relevant given that big jump in goodwill we saw. This is a really interesting tidbit. On May 14, 2025, they adopted a shareholder rights plan, often called a poison pill. This usually happens when a company feels like it might be bought out against its will. They mentioned an unsolicited proposal from HireQuest Inc. at $7.50 a share. TrueBlue's board rejected this. This plan makes it much harder and more expensive for someone to buy a controlling stake in the company without the board's approval. It's a defense mechanism to protect their current strategy or perhaps their current leadership. Looking at share repurchases, they bought a tiny amount of shares this quarter, just 147 shares to cover employee taxes upon stock vesting. Last year, they were buying back stock actively, which is usually a good sign that management thinks the stock is undervalued, but not this quarter. Overall, TrueBlue is navigating a tough economic landscape. They've improved their profitability by cutting costs, and they're using debt to fund growth initiatives like acquisitions. The flat revenue in the short term is concerning. When you look at the longer period, though, it shows a definite slowdown. The big jump in goodwill means they're betting heavily on the success of recent acquisitions, and if those don't pan out, it could be a major problem. They're also actively defending against unwanted takeovers, which suggests management is focused on its own path rather than a quick sale. So what's the verdict? TrueBlue is managing the current economic headwinds by cutting costs and making strategic acquisitions. The financial improvement is there, but it's still a company operating at a loss. The jury is still out on whether their acquisition strategy will pay off, and the economic sensitivity of their business remains a significant risk. Alright, that's our breakdown of TrueBlue's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description and join the conversation. Thanks for watching. See you next time.